All right, today we're going to dive into something called structured asset rotation. Think of it as a whole new playbook, one that's designed to adapt to the kind of crazy, unpredictable markets we're all dealing with these days.
So let's just kick things off with a question that honestly has been on a lot of people's minds lately. Why did that old, tried and true idea of diversification seem to completely fall apart right when we really needed it?
Well, the answer became painfully clear back in 2022. You know the old rule of thumb, right? When stocks take a nosedive, your bonds are supposed to be your safety net. They go up and it all balances out. But in 2022, that just didn't happen. Stocks and bonds went down together. And that showed a massive crack in the foundation of that traditional strategy, especially when inflation is the main thing driving the economy. And if you look back over the last 20 years, it becomes obvious that the market isn't just one thing. It moves through these totally different phases or regimes. You had the big collapse back in '08. Then we had this super long stretch of growth that was basically fueled by easy money. And now we're in this new world of inflation. Each of these environments is a completely different ballgame, and they reward different kinds of assets. So a portfolio that just stays the same year after year, well, it's bound to hit a wall when the whole game changes.
So if that old static model is feeling a little broken, what's the answer? Well, this leads us to a new kind of strategy, one that's built from the ground up to be adaptive, to move with the market instead of just getting run over by it. And that strategy is structured asset rotation, or SAR for short. The best way to think about it is like a smart GPS for your money. It's a system built on clear rules. It's not about crystal balls or trying to predict the future. Nope, it's all about one thing: correctly identifying what kind of economic weather we're in right now, and then automatically steering your money to the one asset that's built to thrive in those exact conditions. Now, you might be thinking, hey, wait a minute, is this just another momentum strategy? And that's a great question, but no, it's actually pretty different. Most momentum models, they're just reacting to what prices are doing. SAR tries to go a level deeper. It looks at the why, the underlying economic engine that's making those prices move, and that's its secret sauce. It helps the system tell the difference between a deflationary shock, where bonds might be your best friend, and an inflationary shock, where those same bonds could actually sink your portfolio.
Okay, so how does this thing actually work? Let's pop the hood and take a look. It all boils down to two core concepts: 4 pillars and 3 signals. These 4 pillars are the only 4 tools in the entire toolbox. That's it. You've got stocks for growth, you've got treasuries when you're worried about deflation, you've got gold to hedge against inflation, and you've got cash to keep your powder dry when the path forward is murky. Now here's the really important part. The system is always 100% invested in just one of these pillars at a time. It picks the single best tool for the current job, and it goes all in. So, how does it choose which pillar to use? It's not magic. It's just continuously asking 3 very simple, very direct questions. First, is the stock market generally healthy? It uses a classic technical indicator to figure that out. Second, which way are interest rates headed? Are they rising or falling? And third, what's the deal with inflation? The answers to these 3 questions, when you put them all together, give the system a clear, logical signal for exactly where your capital should be. Okay, the theory sounds pretty solid, right? But the real test is, how did it actually perform out there in the real world, especially during those big, stomach-churning crises? Let's take a look at the actual data from the last 20 years. Before we jump into the numbers, this quote is absolutely key. It's the whole philosophy. The real value of a strategy like this isn't just about the money you make. It's about the catastrophic losses you avoid. That's what drawdown suppression means. A drawdown is just that painful drop from your portfolio's high point. The number one goal here is to protect your capital from those devastating hits that can take years or even decades to recover from. And wow, this chart says it all, doesn't it? Just look at this. Over the past 20 years, if you just bought and held the S&P 500, you would have had to stomach a loss of 55% at one point. I mean, your account would have been cut by more than half. Ouch. Now look at the bar for structured asset rotation. The worst it ever got was a 15% drop. That is a huge difference. It's the difference between a bump in the road and a total wipeout. And here's the part that might really surprise you. You'd probably think that playing defense and having smaller losses would mean you have to settle for lower returns over time, right? Well, take a look. That wasn't the case at all. Not only did SAR do a much better job of protecting capital on the way down, it actually generated a higher estimated annual growth rate. We're talking about 15% versus about 10%. It's a perfect example of how sometimes the best offense really is a good defense. So I want to be clear. This isn't just some academic theory buried in a research paper. All this intelligence is delivered through a live platform. It's a dynamic, living tool, not some dusty old report you get once a quarter. So what does this platform actually do? Well, think of it as your eye in the sky. It's tracking those three key signals 24/7. It's looking at how different risks might be building up. It's designed to spot early warning signs before a big market shift happens. And then it uses AI to wrap all of that up into a clear, easy-to-understand analysis that tells you what's going on right now. And of course, we've got to give credit where credit is due. The person who developed this entire methodology is Kevin L. Brown, a researcher, inventor, and author who built this system to solve the modern challenges he saw facing investors. So what's the big takeaway here? In a world where the economic rules seem to be constantly changing, a static, set-it-and-forget-it portfolio just might not cut it anymore. An adaptive strategy like SAR is built for this new reality. If you're intrigued and you want to see how this live intelligence actually works, you can reach out to get a free sample and even schedule a consultation to see the platform for yourself.